Okay, well, it's 2:02 East Coast, so I think we're probably going to go ahead and get started. Have one person who's straggling a little bit, but I assume that he'll catch up shortly. So, without any further ado, good afternoon, good morning, good evening, depending on what time zone you're in. I want to thank everyone for coming to our panel discussion titled "Accessing Capital in the Time of COVID: Challenges, Opportunities, and Best Practices." We're going to touch on a variety of topics, including how COVID-19 initially impacted the capital raising process, and then the rapid acceleration in capital raising, and of course, our thoughts on the future, including, and importantly, the durability of this market. We have 1 hour allotted for the panel, including questions that we have prepared in advance, as well as questions received in advance from participants. If you have any questions that you'd like to address the panelists, please submit them through the Q&A system, and I'll read out the most frequently asked questions and ones that have the broadest applicability to the audience at the end. If we do not have time to address your question, we'll follow up separately with our thoughts. We will be recording this session, and a playback will be available shortly afterwards for all attendees. I'm also obligated to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company, and this is also not considered legal advice or the offer to buy or sell any security. Everything discussed is also considered to be off the record. So, also wanted to address something very briefly before the panel relative to diversity. While everyone presenting today is enormously qualified, unfortunately we lack the diversity of balding white men on this panel, myself included, which was importantly not done by choice. We made the call to go ahead with the panel despite a qualified woman who had unfortunately had to cancel right before we started the marketing. Locust Walk's 2 previous panels had 2 women as leading speakers, not because they are women, but because they were the best people to share their views on the subject. We strive to include all perspectives, including as much diversity as feasible, and we'll certainly do our best going forward. So on that note, I want to thank the panelists who've joined in the discussion to share their views on what makes for a successful capital raise in this environment, and I will introduce each of you guys briefly. So starting with Greg Beloff, who's the co-founder and managing director of Danforth Advisors, a company focused on providing finance support and strategy for life science companies. Greg Beloff has more than 20 years of experience in the life science industry and has been an investment banker, and for the last 19 years has been the CFO for biotech companies ranging from venture-backed startups to publicly traded companies. I also wanted to say separately that they are a great group to work with, despite it appearing that their office is actually a boat on the Charles River. Ryan Coleman is Managing Director and Global Head of Capital Markets and Sales at Locust Walk, a global life science transaction firm. He brings a career in investment banking and sales from Bulge Bracket Investment Banks, where he closed more than 800, that's not a typo, 800 deals, and was most recently Global Head of Equity Sales at Jefferies before joining Locust Walk about 2 years ago. He's based in the New York office for Locust Walk, although does not work in the Freedom Tower. And Bill, glad you're on board. And now you are on deck for intro. So you're a partner, obviously, and co-chair of the Securities and Capital Markets practice at Mintz. Bill works with biotech companies, investors, and investment banks in raising capital in creative ways, including various alternative strategies for accessing the capital markets. So welcome to the 3 of you. Thanks for joining. So now on to the fun, just in time. So I have a bunch of prepared questions, and we're gonna keep this a nice, fun dialogue. So all of us have been locked down for 3 months, which is why we're all in our homes with nice backdrops as opposed to in our offices. But states, importantly, are starting to reopen. So I want to dive into the state of the private and the public capital markets and your thoughts on the future. So I'm going to start with my colleague Brian Coleman and get your views on how you believe crossover financings have been holding up.
Sure. Thank you, Jeff. So I think just maybe by way of background, just a few thoughts on the private market in general. Since 2016, we've seen a doubling in the amount of capital that's been allocated to private deals overall. We've also seen a material change in the size of those deals on average from somewhere in the mid 20 millions to close to $50 million deals. So much larger, earlier stage deals. I think that's consistent at almost every level. But the encouraging part is the inflows into the space overall, specifically funds that have opened up focused on private. So fair amount of capital out there right now and a fair amount of demand. And to Jeff's points on crossovers, we've seen a significant improvement or flow of crossovers year to date. I think there's somewhere in the neighborhood of 12 plus that are priced this year. And ultimately, we are involved in a deal that closed Friday that we'll get announced next week. It was a $115 million deal that was upsized to $150 million, and it served its purpose. We were able to almost double the amount of investors that will carry over into an IPO. Ultimately, it will help with, and what we've seen out of all of the crossovers, companies that have done a crossover round ultimately have had a more significant step-up function in terms of valuation. They've also had better aftermarket performance in the market itself once they start to trade in the public markets. And so I think it's a trend that will continue. There's clearly an appetite for it and an opportunity for us to continue to put in front of investors.
So Brian, just real quick and follow up to that before I go to some of the other panelists. It felt to me, at least, like there was kind of a bit of a pause and people taking a bit of a breather at the beginning of the COVID-19 situation. And then at some point along the way, someone just pushed the gas pedal down and it's just zooming. Is that your impression, or how do you feel the market evolved over the last 3 months?
Well, I think you saw at the start of the year, you saw inflows into the market were sort of in line with where they had been historically. And there's been a significant move in the last couple of months, obviously, given the backdrop that we're dealing with a virus situation that has us all at home. I think it's put a focus away from drug pricing and a focus on innovation and where we are in the sector and the opportunities to invest in earlier stage companies. So I don't see that changing anytime soon.
Got it. Bill, what do you think about the crossover market and your view on it?
I think it's actually been turbocharged by the pandemic. I think when at the beginning of the year, we were starting to see things slowing down. People were afraid there was going to be a correction in the public markets, whether it's the coming election or drug pricing concerns. And I think things were starting to slow down. When the pandemic first hit, everybody was just kind of in wait and see mode. But now the public markets have been scorching hot. And once the public markets get hot, that heats up the crossover market, because the crossover market is ultimately looking forward to the coming public markets. And I think there's a perception among the investors that the public markets have gotten a new lease on life in biotech. So I think that inevitably is going to heat up the crossover market. I think there's a few reasons for that. One is that there's no longer bad mouthing of drug pricing. There's the focus on innovation, as Brian was mentioning. I think the generalist funds, who often drive public demand, biotech looks better than other growth sectors whose fundamentals have actually been affected by the lockdown. So I think for a number of reasons, the public markets have gotten hot, and that has in turn made the crossovers, given it a new lease on life since the pandemic.
Got it. And I guess just one brief follow-up on that. I mean, these rounds are getting bigger and bigger, but do you perceive that there is a difference between the companies that are getting financed and those that are struggling? Because it's not all rosy, I have to imagine, for every company out there.
No, I think it's been a tale of two cities for the last couple of years, or certainly the last year. There's some companies that are raising $50 million in heated crossover rounds, and then there's a whole host of companies that are having a hard time finding an outside lead for a $15 million round. And I think that is the case here as well. So I do think it, and for those companies, the pandemic, I think, has actually made it worse, because to some extent, new investors that might have come in are trying to make sure they shore up their own portfolio companies to get it through this. So I think it's overheated the hot companies. I think it's made it a little bit harder for the companies that were struggling, which is a challenge.
Sounds like an income inequality argument.
Yes.
Hot topic. So, Mr. Biroff, what are your views?
So I agree with everything that the panelists have said before, and what Brian and Bill have shown is that what's really interesting is there's a bit of a dislocation here. When Bill was talking about a tale of two cities, we've got companies who are struggling, in fact, and they're not able to generate the clinical catalyst that they need to raise money, because one of the things that has profoundly affected our industry during the pandemic is the fact that elective procedures, that being clinical trials, have not been ongoing. So there are companies that are really struggling to keep pace. For investors who have money in those, they're looking to get that money out and backward integrated into crossover investing. I think that there's also a perception amongst crossover investors that there is a general dislocation in market value. And by integrating their investing, starting with the crossover and then dollar cost averaging across an IPO, they can get more ownership at a lower cost basis.
Yeah, I mean, that seems to make sense. So I guess, do you perceive that there is a shift to crossovers from public, or how does that square with kind of the mood where initially in the kind of the COVID early stages, the follow-ons, frankly, slowed down dramatically, but again, in more recent times, we start to see those zoom up. So is there a flow issue as to where the focus is on privates versus publics, or how do you perceive these crossovers are prioritizing their time?
I think it's a good question. I saw a recent study by another investment bank that showed that there are over 100 companies in the capital markets right now with a combination of less than 1 year of cash and less than $200 million in market cap. And that obviously does not bode well for those companies. So wherever there is trapped capital there, that's being liquidated and reallocated towards the private markets.
Interesting. So the have-nots on the public side are getting worse to the haves on the private side. Is that what I heard?
Yeah, and I think it's very hard if you're a public company today. It sometimes is be careful what you wish for. As you take on life as a public company, it becomes more expensive to operate and to exist, and you're more open in terms of your disclosure requirements. Yet at the same time, you're not allowed, but you're not in an optimal position given the COVID crisis to prosecute your programs effectively. It becomes a very, very difficult position, and certainly Brian can talk to the trading dynamics of what we refer to as microcap, and that would be those companies that are really, they don't have a lot of float, they don't have a lot of liquidity, and they're churning more retail investors than they are institutional investors.
Yeah, no, that makes sense. So we'll get to that in a second, relative to kind of a reverse merger and how that looks versus a pure IPO, and I'm sure both Brian and Bill have a view on that. So I guess just maybe taking it from the crossover world to the IPO world, are you guys seeing any shifts in that market, or is that just as red hot as the crossover world? What is, maybe Greg, you just want to keep going off of that, because I know you guys are involved in an awful lot of IPOs so just maybe just dive into that a bit.
Yeah, absolutely. So just by way of background, we do both the strategic side in terms of organizing syndicates and drafting S1s, and the technical and accounting side, which is not nearly as glamorous, but is equally important in terms of the preparation of the S1. So to that end, I think that we're seeing just an incredible run of public offerings, and the queue is continuing to get longer. And even the folks who are lining up to do a crossover to an IPO, it was interesting. I read this morning about a company here in Cambridge that financed, and one of the questions from the Economy reporter was, you have a lot of crossover investors, you must be thinking about a public offering. And the company, of course, did their best to defer their response, but it's clear that people are focused on that crossover to IPO. And one of the things that really continues to drive that is that the IPOs are being outsized, they're being upped in terms of valuation, and they're performing extremely well in the aftermarket. So overall, it's worked out quite well, at least in the short term.
Yeah, obviously that company was built to keep their mouth shut relative to their IPO prospects. But Brian, maybe you want to comment a bit on what you're seeing. I know we're doing a number of IPO advisory and kind of another side of the house from what Greg is doing. But what's your view after talking to all these banks and kind of the appetite in the IPO market?
Yeah, so we're, like I said, we successfully closed on a crossover round for a $150 million raise, and now we're in the midst of working in an IPO advisory capacity, helping facilitate a process with each of the investment banks to decide on a syndicate. And so ultimately, in meeting with a lot of the banks recently, I think it's interesting what the backdrop of the public markets is right now. You have, I think it's in the neighborhood of 14 IPOs that have priced this year, which is down slightly from last year, although the follow-on offerings are up significantly. But the price on average has increased about 85% for these IPOs since coming to market. So not only is there demand via the crossover round into the IPO, but there's clearly buying demand once the company goes public, which is reflective in the valuations that a lot of these companies have been able to absorb since going public. On the follow-on side of things, I think it's about a 70% increase on a year-over-year basis in the amount of follow-ons that we've seen at this point last year, and which is pretty material. So I think the demand is there. And I think it will continue for the short term. The question is, longer term, does it remain intact? I think you're seeing a nice step up in valuations from crossovers that literally just ultimately raised capital 3-4 months ago and are in the public markets with a nice step up function in terms of valuation. So I think that's the overall backdrop. May was the best month for issuance in biotech since 2008,
Wow.
which is sort of a crazy statistic given where we are in this environment. But the demand is there, the supply is there right now, and so everyone's looking to capitalize on it.
Yeah. So Bill, I mean, I know that you work on both IPOs, but also do a good bunch on reverse mergers, and I'm curious your views on the IPO world, but also what you're seeing where companies asking you of alternate routes to get public.
Yeah, I mean, I think any company that had a large crossover round that has $100 million IPO down the road, that's easy. That's what you do. Again, the hard part, the challenging part, and the fun part of what we do is try to find solutions for the companies that don't have the red carpet rolled out for them. I think the reverse mergers are actually a very good option right now, and I'm talking about the sort of the ones where exciting private company merges with a public company that had a failure in its drug trial. It still has some cash. It has its listing, and they pair up with a private company, and now the private company can sell securities as a public company instead of as a private company. I think those are a really good solution right now. First, there's a lot of public companies. A lot of companies have gone public, and some of their drug trials haven't gone well. So there's a good supply of these NASDAQ fallen angels that are ready to dance. And there's a lot of really good companies a lot of good private companies that aren't quite on the hot trail. And this allows them to get public that way. And I think there is a perception, and I think also reality. There are a lot of really good private companies where the crossover funds may not want to put money into them as a pure private company, but if they can model them as a public company, they are interested because they know that their liquidity is a little bit more near term. And so doing these little I look at these reverse mergers as basically going public in your crossover round. If they're done right, you're doing a crossover round at the same time you're reverse merging with the public company, and all of a sudden they know they're going to have liquid stock at closing. All of a sudden, that's a very different modeling proposition for the crossover. So they may be willing to put some money into those companies, and it gives them a chance. And then I also think we're seeing in this wave of hot follow-on offerings, we're seeing everything from the small deals to the mid-sized deals to the large deals. It's all there. So I think for the companies that are have a strong story, but they're not scorching hot, I think being public does answer a lot of questions for them. It gives them a chance to keep fighting. And I think a reverse merger is a very good bridge right now.
Interesting. The one thing I would add to what you're saying, Bill, is we've seen a bunch of companies that, to your point, would probably be better as public companies to have the financing kind of become more of a crossover, really a pipe if you merge into a company. But we're actually seeing a lot of people with an interest in doing a reverse merger, but not into a shell, but where there's a strategic angle and where the private company could actually get stock in a public company, but it's not just taking over their cash or their listing, that there's value to combining the two from either platform perspective or product perspective or management perspective. So that's another twist that I'm sure that you're seeing, and I'm sure Greg you're seeing as well. But we keep an eye on that, because that is also another way of getting public, but there aren't that many shells available. And so thinking a little more creatively about what is a shell, or how could you actually get public. So just maybe that's some food for thought.
Definitely.
I guess, the follow-up question of all this, we're talking about the good times rolling now, best month on record since 2008. How long can this last? I mean, we said that in February, March, before COVID, and then things did take a dive for, I don't know, a month, call it, and now things are back roaring more than ever before the economy is fully back. So do any of you have views as to, is this something that's going to go through the summer and then there's a second wave and things are going off a cliff, or does the election still matter? Does anyone care about the election? Or is this just the new normal because everyone's focused on biotech and now we are the saviors of the world as an industry and people are going to invest there? So Bill, I'll start with you since you went last. What's your crystal ball say about when this party's going to end or not?
I think this is actually durable. I think this part, until the pandemic, I think this party was going to end sometime this year, that we were due for a correction. We were due for a slowdown. I think the pandemic has fundamentally changed it. It's for some of the reasons we've discussed. I haven't heard anybody complaining about drug pricing in a while. Nobody's worried about what the what the candidates are going to say about, drug prices being too high. That's just not where the world is at right now. Second, this business with, it really is true when you look back at all the huge booms. It's not the sector funds. The sector funds are in the sector good times and bad. They might be more bullish or less bullish, but they're there. When the generalist funds start pouring money in, that's when you start seeing the runaway. And I think we're seeing that. And a lot of that, I think, is durable. Again, biotech is in a really strong position now compared to other growth sectors. So I think we're going to have durable generalist fund. That means we have even more demand, more money being pumped in. I think that's a recipe for a long extension. So I thought we were heading for a slowdown this year. I think we may not see it for another 2 years.
Wow, sounds good to me. Greg, you agree with him?
Well, I don't know if I'm that prescient to know what's going to happen. I do know that all bull markets come to an end, and maybe it's the CFO in me that says, I think that regardless of the market conditions, this is a time to be strategic in terms of both allocation of capital and your fundraising strategy. And what we work with our clients on is optimizing that balance of capital consumption and how long does that last and where does it take you to, and generating proof of concept data, diversifying if it's across a platform. I think there are a lot of strategic components that often get lost in the excitement around a bull market, but now's the time to be absolutely strategic and focused in terms of capital allocation and, in a way, capital preservation.
Dr. Coleman, last but not least, what do you think?
Sure. I mean, I kind of agree on both fronts. Ultimately, I think a lot of this has to do with fund flows, and a lot of it has to do with the convergence of capital, which was happening before COVID, and then I think it's probably just been enhanced as a function of COVID. We're just seeing more money into the space. We're seeing a lot more money being raised specifically to put to work in earlier stage companies outside of the public markets. So I think if the foundation is there to invest in these companies and help usher them into the public markets, I don't see that changing anytime soon. It is an election year, and one would have guessed that would have a material impact on the space. But I think given the current environment, it's been a very good backdrop for fund flows into healthcare biotech in particular. And I think April rather, there was close to $9 billion that came into the sector. So it's a material number, and should help the performance of the sector going forward.
Cool. Sounds good to me. I'm going to switch gears briefly now to get some practical advice for the attendees to hear what is really the best practice for raising capital in this new normal. Because whether or not there's a pandemic going on outside, whether or not you can go eat at a restaurant, it has definitively impacted how capital is raised. So Greg, maybe just starting with you, because you probably see the most number of companies from the the capital raising process. How has that process changed with virtual management presentations, due diligence, and give us a flavor as to the impact that's had on the appetite and how to actually make something happen.
So it's interesting. I think from an appetite perspective, not much has changed, but from an operational standpoint, a lot has changed. And I actually just worked on an IPO, or well, we're in the middle of it, confidential filing. And one of the things that I noticed, and for all those attendees who are thinking about a raise or a registration process, one of the things that we tend to do is, or we used to do in the old normal, was to get together a lot. Org meetings were always in person. Printer sessions, you were always at the printers. What has been interesting is watching the effect of the virtual world on the actual process itself. And I think it adds a little bit more to the process. It's not as easy to exchange ideas or question numbers or get quick fixes on an S1 when you're not all together at the printer. So I think you have to keep that in mind when you're compiling your team, when you're planning out what that initial registration statement period looks like. And then as you transition to the next phase, the marketing phase, the test the waters meetings, those are all going to be virtual, as will the roadshow meetings. And I think that trend, by the way, is here to stay, frankly, for all of us, whether it's buy or sell side. It's just easier and it's less intrusive. But what it does do is place a premium on the materials that you're using and your ability to communicate effectively in a virtual environment. It's obviously a little bit easier when you're in person to read body language, to point to things in slide decks. You can't necessarily do that virtually. But if you really take your time with the materials that you're putting together, starting with the business section of the S1 that underlies the ultimate roadshow presentation, I think you'll do very, very well in a virtual environment.
Yeah, so before I go to Brian, because I want to hear your experience with the deal that you just closed, but Greg, is that the same for a crossover / IPO as it is for, call it a Series A? And I mean, in the traditional venture world where there are fewer classical investors, that the higher touch process, do you see that really being the case, that it's here to stay doing these virtual presentations, or do you think that there's going to be more friction on the earlier side of the ledger as opposed to the later stage side?
It's a good question. I right now, obviously, everything is virtual. I don't know how soon we'll return to seeing management teams in person. I think at the initial stage of investment, people very much want to know who they're investing in. It's a little bit easier if there have been 1 or 2 rounds and there's a relative track record. But for the near term, and we can look at the near term as the next at least year, if not more, these are all going to be done virtually. And so again, premium placed on your ability to communicate virtually and your ability to be prepared to interface with investors in a digital world. And so things to think about: what does your data room look like? How accessible is it? How consistent is your description of your company and the presentation you're using? And what's the track record of your management team? In other words, do you have folks who have been there and done that, and you're going to be afforded a little bit of credibility, more so than if you're a set of first timers?
Yeah, but if you are a first timer, and most companies that are financed by VCs actually are run by first timers, that presents a challenge if they haven't worked with that investor before. And so, at least my view would be getting the right introduction to that investor, having that right relationship will go a long way towards getting over that hump.
Yeah, I would agree, and I think that's a really important point. And what it relies on is community. I mean, that's what this is so special about our industry, is that we are an incredibly integrated community. And the more that you can avail yourself of relationships that you have, folks with whom you work, advisors or third parties, the easier it's going to be for you to not only ferret out who are the right people to talk to, but to get the right introduction into those people.
Cool. So I'll go to you now, Brian. Sorry about that. Greg likes to talk a lot, so I'll give you some floor time now. What are your views on what just happened with the financing you closed, and and kind of the virtual nature and talked about how it worked or didn't work and kind of your views on how that's going to go going forward.
Well, I think there's a couple things at play. One is before all of this happened, I think technology was trying to creep its way into our process and sort of how we all make ourselves more efficient. I think COVID obviously speeds all of that up. Having worked at a different platform and having looked at the cost of travel and the time spent on the road and trying to coordinate all those things, what I found and in talking to investors, they feel like today's process is a lot more efficient. I think ultimately what it boils down to with investors specifically is, do you have relationships with investors, and how deeply rooted are those relationships to put companies in front of investors for the possibility of being part of their round of capital raising. What we just lived through, to your point, Jeff, is a really shortened roadshow, a virtual roadshow that was, for all intents and purposes, sort of 2 weeks, 2 weeks and change for a $150 million crossover. And we were able to cover Europe, Asia, and the United States in that time frame. Something traditionally like that could have taken somewhere between 3 and 4 weeks to do, with a lot more cost associated to the process. So I felt like we effectively portrayed the message. We were able to set up the right meetings, follow up those meetings with deeper dives into the science and the data room. So I think it worked pretty seamlessly. And I think generally speaking, what we're living through, investors and companies are living through as well. So everybody's adjusting, but from that process specifically, it worked quite smooth.
So no, that makes sense. And just maybe to follow on the question I asked Greg about earlier companies doing Series A's, the relationship with the investor was more important perhaps, because usually those take more time for diligence, et cetera. What will be your recommendation for companies that either aspire to be or could be in that upper echelon of crossovers, but might not have all the relationships to those investors? How do you get their attention? What is in a virtual world, how do you make sure you're on their radar, and how do they get the perception or the reality that the deal is actually hot?
Well, I think to Greg's point, materials that you're actually using to engage with investors are incredibly important. So putting in all that pre-deal prep work that like we do before we launch a deal, just in terms of getting it to a point where it's something that can be consumed by investors, and it's pretty straightforward to entice them to take the phone call and essentially move forward with the first meeting. So I think it's just an adjustment from that standpoint. But beyond that, I think there are a certain subset of people that prefer face-to-face meetings. They want to see someone's body language. They want to know that they can trust the person. There's a lot of that happens. So that's, to me, that's going to be the biggest adjustment in this process, is that world of people that has historically kind of operated that way, adjusting to the new world.
Yeah, either that or they won't invest or they won't receive capital, because it's probably not going to happen anytime soon. So Bill, I know you tend to get involved obviously earlier on in the process, and clearly the documentation, et cetera. Have you had experience with kind of the virtual presentation or virtual negotiations with investors, or how does that work?
I think it's, on the one hand, meetings you used to have in person, you're having on Zoom. On the other hand, I'm finding meetings you used to do by phone, you're doing on Zoom. So if you're, in some ways, you can actually develop a more personal contact, because you're constantly talking to people, in your t-shirt in your room, so I think there's an opportunity to actually have more deep interaction, because we're going to so much efforts to figure out ways to be with each other that it's actually becoming more personal more of the time. The way I look at it, I think it's very important in times like this to have a tight story. This is not a good time to go in with pie in the sky valuation and, just being difficult to bring down to the table. It's never a good time for that, but particularly times like this, it's all about focus, being tight, being someone that's going to be easy to transact with. But I think that it's very workable, because it forces you to in times like this, you can't go out and see everybody. So everybody's sort of focusing their interactions and focusing on a few things. And I think that often can actually increase your business if you focus it right. So if you're being thoughtful about where you're going to put your energy and then put more energy in developing those relationships, I think you can actually do better in this environment.
Yeah, so that's a great point, Bill. And sorry to dive even further deep into this. And the intent is not to make this into a sales training course, but I couldn't resist where my colleague Brian Coleman ran global equity sales for a major investment bank. And I'm curious, Brian, if you have any tips for the audience about how do you actually build or strengthen relationships in this virtual environment if your goal is to ultimately raise capital. Is there anything that people can do? Obviously the story is important and all that process, et cetera, but in a human-to-human basis, how do you build relationships through a computer screen?
Well, I think that given the environment, people are more efficient with their time, and there is more availability in schedules, at least from what I've seen, with investors that maybe we don't have a relationship with today, but we're building. And so they've made themselves available. And I think the ability to interact face-to-face, put somebody in a more personal setting, in my experience here in this environment, has opened them up to a better, kind of more open and honest dialogue. I think the other thing to consider is, and I've done some of this and I'll do more going forward, are just virtual lunches and virtual, meetings at the end of the day, just to kind of catch up from a personal perspective. It doesn't always have to be about work. So we've sent lunch over to a few investors and we've done a video call. They've eaten lunch. We've eaten lunch at the same time. I think it's a great idea and sort of puts people at ease and gives you the ability to enhance that relationship. So I think you have to be creative is the point.
Yeah, and unfortunately your good golf game is not going to help you here, and it's kind of the great equalizer for Greg and Bill, who are terrible golfers. So do you guys who are now at the level playing field with a guy like Brian Coleman, Greg, how do you build relationships virtually? Especially, I'm sure you know most of the investors, but whether it's with new clients or maybe just give some tips in your view that how to build these relationships.
I think so. I think Brian's comments were spot on. And I would add that this is a time, I said it previously and I'll say it again, this is a time to lean on community. And who else do you know? Who does your board know? Who do your colleagues know? And as Brian well knows, one of the ways that the sell side learns who is hot and who is exciting in terms of the next canon of innovation is to go out and find younger companies that are doing innovative science. So making sure that you know who the investment banks are, making sure that you know that equity capital markets is the group that sells the deal, that bankers are helpful, but equity capital markets are extremely helpful. They can be really useful allies in terms of introducing you to folks or recommending various funds that you should talk to, whether that's because they like platform stories or product stories or therapeutic area stories. I do see a lot of value in that too.
Got it. And I'll have you start the next question, Bill, but just kind of piggybacking on that theme and zooming out a little bit, where do you recommend companies focus right now? There was a question in the beginning of COVID, deals were still getting done and those deals probably started long before COVID. And as we get further along into it, we're probably going to start getting deals that will have started or at least be earlier stage, in the beginning period of COVID is when they actually get going. So should people start a brand new de novo fundraising process now, or should they hold off until, quote, a better time if that exists? Or how do people think about how to spend their time relative to raising capital to maximize their chance of success?
I mean, I think the market is good. So if you have a good story and there's interested investors, absolutely you should go for it. Notwithstanding the fact that I think we're on a long run, you never know. So it's a good market. If you can raise money now, do it. It depends on, it totally depends on the situation. I mean, if you're one of the have-not private companies that's having a hard time lining up hot investors and you're waiting for people to kind of be in a mood to look later, then I think there's things you can do to get ready, whether it's, going out and having the you need to meet your investors well before you ask them for money. So it's worth putting in that time when you can, as you can. I do think the reverse mergers are a great story. If right now you're having trouble raising money, but you spend the next 3 months becoming a NASDAQ company, and then all of a sudden you're public and the market's appetite is better for you at that point, then that's a great use of time. So, but I think it just depends. If you're in a strong position, if your story's in a good position, I think it's a great time to raise, because it's a great time to raise. And when it's a great time to raise, you raise. So
When they're passing the cookies, you take
yeah.
them. What do you think about it?
So I also was taught a long time ago by the late Mark Selesky to say, when the cookie plate is passed, take two. And I've always lived by that adage. But I also think it's time to be creative too. We've talked a lot here about equity financings. And this is something, Jeff, you guys do a lot of work in. Looking at partnerships. Corvidia today announced a tremendous deal. And we've seen option deals, outright acquisitions, partnerships, licensing. I think it's important to keep a wide scope of optionality, whether it's equity dilution or asset dilution. The pace of innovation isn't slowing, so I wouldn't encourage anybody with a really good idea or a different way to do things to simply slow down because of exogenous factors. I would say get creative and really think about different ways to be able to generate the capital and the resources to prosecute what you have.
Yeah, we'll get to dual track in a second. It's a great segue, but I'm curious before that, if Brian, if you have any views on kind of timing, when do you start? How should people think about the current environment relative to their process? You're on mute still. Had to happen at some point to someone.
Yeah, it just did. So I think I think capital raising and to Greg's point, management teams' kind of thought process should always be around what are my options? What are my options in various different markets? If the market's good, obviously, and you need the capital, or if you're in position to take capital that's there for the taking, to stow away for rainy days, not a bad idea. If it's not the right time, there's other opportunities to get involved and maybe just do non-deal related meetings with investors to kind of enhance your book of relationships when the market does turn in your favor and you come back and you're looking for capital. I think what we've seen out of Asia is interesting as well. Just the creativity around an investment and then potentially getting involved from a joint venture standpoint in some form of a partnership or in manufacturing or in trial development, et cetera. So there's a lot of different unique ways in areas for companies to kind of focus in on regardless of the market backdrop.
Yeah, and makes total sense. And one of the things that I think was causing people to freeze and seize up was not knowing when their clinical trials were going to restart. There was actually a question from the audience about that. I think ultimately, as we're seeing a push to reopen hospitals and restart the clinical trials, that means that companies aren't just burning G&A without actually getting advancement of their development, but you can actually restart the trials, start to hit value inflection points, et cetera. I think that's actually going to add further fuel to the fire. Anyone disagree with that, or does that seem to make sense? Nodding of heads. Good,
Yes.
added value. That's good to know. So I guess just kind of piggybacking off of what Greg, what you said about kind of a dual track, and this is certainly not a shameless plug for Locust Walk. I didn't pay you to say that. I'm curious though, what is your view on the idea of a dual track? I mean, with a strategic angle and a partnering angle, is that something one should do, or are you better off just, since the financing market is so hot, going the single track, or how have your clients thought about that?
So I don't think of these things as discrete or idiosyncratic events. I think this is something that a good management team is evaluating constantly, and especially in light of changing capital markets and changing opportunities in the landscape, where therapeutic areas are advancing, where you see differentiation. As a management team, you should be evaluating this constantly, and I think that keeping surveillance in terms of both asset dilution and equity dilution allows you to be opportunistic at a time like this. So the first ones to the window, why did they get there? Because they were prepared. And one of the things that we would stress to anyone is preparation is going to ultimately be your best friend in terms of being able to adjust to whatever the circumstances are that, again, we just can't predict. They're hot now. I don't know what they'll be, but I do know that chance favors the prepared.
Yeah, so let me push back on you a little bit. I've at least learned or heard the conventional wisdom is that the public market investors, they want the lead asset for themselves. They don't want it partnered. So if you're going to do some partnering to raise capital, you probably have to go to a secondary or tertiary asset or some platform deal where you might not get that much value. And we actually did a study at Locust Walk that talked about the impact of those deals on your stock price. So I'm curious, is it really another option? Or if you do sell a material asset, does that hinder your ability to raise a crossover or get public?
Well, it may be that a better return for your investors is to actually look at that alternative pathway to exit. I don't know that the two necessarily are mutually exclusive. I'm sure there are situations where, and I would agree with you, adage says that about 80% is accorded to your lead asset. So you partner that and there's not a lot that's left. But opportunities for platform companies to create partnerships in these environments, very important. Validation is, I think, an important consideration in terms of differentiating your company, and having the partnership of a larger pharmaceutical company and its resources can be empirically a good thing. But look, I just to close out, I agree with you that and it's not going to be right for all companies, and that's why, to me, it's a constant evaluation by a management team. And when you're looking at that and thoroughly and thoughtfully, you'll be able to assess what the right outcome for you individually is, as opposed to a collective herd.
Well, I'm trying to foster some dissent, but apparently I'm not doing a good job. So appreciate you agreeing with me. Brian, I know you have a strong view on kind of the dual track, and there's a downside to a dual track for sure. I'm curious if you have some thoughts you want to share. Second time. There you go.
Given my history, I think a lot of what I did before joining Locust Walk was single track, and one of the attractions for me to join Locust Walk was the ability to work on dual or triple track processes. I view our role as creating optionality for company management teams, and you hear me say that all the time. I probably use that term too much, but at the end of the day, sitting in a seat running a company, you need to know which different levers you can pull, whether it's a traditional capital raise, running a strategic process at the same time, or ultimately a potential partnering process. And we've done all the above with a number of companies that we've worked with. Zyphos in particular is a great example that was sold at the end of last year. We were running a capital raise and a strategic process at the same time before they ultimately engaged in their sale to Astellas. So I think there's benefits there. The balance of those two worlds, though, is working with investors on the capital raise itself, and sort of engaging in them with the mindset that there is another process in place, and sort of getting their mind share and their time to spend on looking at the investment. But I think overall, and we have another company we're working with raising capital, and ultimately a strategic stepped up, not to take the company out, but ultimately to step forward with a pretty significant investment in the capital raise that we're involved with currently. So I think that's the other piece of it, is we're seeing a convergence between those two worlds. And maybe it's a step function, an early stage step function, into writing a check to get more involved and get to know the company a bit better before a takeout.
Yeah, it makes total sense. I mean, then they have a front row seat to the company. They can, have board observer rights, and they can know what's going on ahead of the other competitors. So makes a ton of sense. I guess, in an earlier market, Bill, and I'll finish this question on you. There used to be the conventional wisdom that you'd run a dual track, sell the company, do an IPO, and whichever gave greater return to shareholders is what would happen. There's been, several examples of that. I just don't think we're seeing that anymore. Has that been your experience, or if so, is just because the markets are so much better than the financial markets better than the strategic markets? Do you have any view on that?
I think it's probably the latter. If you're heading towards an IPO with tailwinds of a big crossover, it's hard to kind of beat. The IPO markets are good. That's probably your best choice. So I think that's right. I think that whereas with the companies, again, it's the tale of two cities. The companies that aren't on that fast track, I think they have to be more creative and have different options, a different way, and do different things to get validation. To Greg's point earlier. So I think that's right. I think for the really streamlined stories going straight to big crossover to IPO, I don't know if there's, it's hard to beat that. Occasionally you'll see an offer come in, but the IPO process is so attractive for those companies. I think it tends to be a focus on just executing.
Makes sense. And I do want to ask one question for kind of the have-nots, the other city in the tale of two cities. We focused obviously a lot on high value crossovers, IPOs, but for the call it sub 200 million market cap public companies where apparently there's flows going out of them into crossovers, and the private companies that are not getting the 100 million, 150 million crossovers, what are some of those other points of creativity? I mean, there was a question from the audience about family offices. Brian, you mentioned Asian investors. Maybe Brian, I'll have you start this one because I know you spend a lot of time on not just the traditional but non-traditional investors. What are some things creatively that the audience can do if they're not in the fortunate position to be in one of these hot companies? And are those alternate sources still active today, or has COVID changed that for them?
No, I'm not on mute, which is great.
Good. Well done.
I think ultimately those sources are more than open at this point, and we've seen it now on multiple deals, even during the current environment from Asia. So they have an appetite. They're very open-minded, and I think there's pockets of opportunity there. And we have, as you know, we've sort of built a practice around dealing with larger family offices that are sophisticated in the life science space, that ultimately invest a fair amount and get involved, not just passively, but actually get involved with connections, et cetera. So I think those two paths are wide open for companies right now, regardless of market cap and sort of stage of development and everything else. So those are two areas to tap in this type of market.
Yeah, I guess if the company has more options, they're not going to care as much about Asian investors or family offices. They can go to the who's who of the institutions, but those who don't have as many options, theoretically, that's a more viable strategy. Is that fair?
Yes, it is.
So Bill, have you had that same experience, or what has been your view on kind of these non-traditional sources?
Yeah, I think that's right. I think there's the family offices, and the other pool of underappreciated capital is sometimes high, either retail or high net worth, however you want to call it. And I think one of the reasons a lot of these reverse merger structures come out is they give an access for companies to go to retail and family offices that need to have a higher liquidity than a traditional private company does. So I do think one of the things that companies like that should always look at is the whole point of a deal structure is to give you an opportunity to pair up with an interested money. And so if your story is compelling to either retail or the home offices that often have a particular therapeutic focus, and pairing that up with somehow getting yourself into a public vehicle so that they have more liquidity, that can make sense and give you access to that other pool. Got
it. And Greg, just kind of last on this question. So have you seen a lot of your clients accessing either Asia or family office money in addition to the usual suspects, or how has that played out in your practice?
No, absolutely. I think people are focused on all different pools of capital. One of the things that I would throw out, so Bill had talked about reverse mergers quite a bit. If you're fortunate to be a public company, one of the things that you should consider, if you don't already have it, is an at-the-market facility. These are ways to discreetly sell pools of stock. They can get you somewhere between 3 to 5 million a month, depending upon your liquidity. And I think it's a very efficient, cost efficient, and capital efficient way of not only raising money, but figuring out who potentially is interested institutionally in buying your stock. And I do know of someone who just the other day took an at-the-market interest and flipped it into a registered direct offering. So that's something that if you're in a public company, you should definitely consider.
Got it. Well, for those of you who have tuned into these webinars in the past, you'll know that I like to end them on a positive note. So I'm going to ask each of the panelists to kind of take 30 seconds or a minute. We only have 3 minutes remaining to give kind of your final thoughts about how capital raising is going to change in the future in a positive way. So, Mr. Coleman, why don't you start us off?
Sure. Thank you. So I think generally speaking, the backdrop of the market is positive. I like the convergence of capital into privates, dedicated sources of capital that are there for extended periods of time. The rotation into healthcare from generalist investors, I think will create a nice bump for companies, particularly probably in the crossover and public markets, less so with the earlier stage stuff where they have a tendency to shy away. But generally speaking, I think if people can sort of adapt to this new world of virtually interacting and the ability to manage relationships, I think it's incumbent upon all management teams, regardless of where you are in your process, to be more and not less interactive with investors. So happy to help in any way, but I'm encouraged by the backdrop of the market overall.
Good stuff. Bill, any positive final words about future capital raising?
I think it's very positive. I mean, you've got the generalist funds coming in, and I think that's not going to change. I think the advantage of biotech relative to other growth sectors we're going to see that for a while. We're not worried about heating on drug prices. I think we're at the beginning of a real. I think we got a 2-year extension on our run, so I think it's going to be very positive. And I also think that there's kind of an increase in passion, which always helps with this sector. That people know that we need to come up with solutions for things, and I think that makes people really, really focus on this. And I actually think the restrictions from the pandemic force us to focus on which relationships we're going to pursue and put more time into them because we're forced to by being remote. And I think forcing small companies with limited bandwidth to focus actually is better. So I think we're heading into a nice stretch where people are going to be more focused, and there's going to be a lot of money available, and there's going to be a lot of enthusiasm.
Cool. Greg, final thoughts?
Yeah, so just picking up on what Bill said, I think it's great as a CFO to see people refocusing on capital efficiency and looking at whether you really need to take 35,000 square feet in the heart of Kendall Square, or whether you can find a better allocation for some of that capital. But look, I think we're in a tremendous time. It's an unprecedented time. We're fortunate to be members of a community that is so innovative and supportive at the same time. And I guess I would close by just saying thank you for having us. We appreciate it. And for everybody who took the time to tune in and listen, hopefully this was helpful. And again, appreciate the time.
Awesome. So thank you to the three of you for your thoughts. We're out of time now. And again, I appreciate, as Greg said, everyone joining us today. As a quick reminder, there will be a link to the recording that will be sent to each participant via email. If we didn't get to your question, I tried to answer or get to as many of them as we could. We'll do our best to answer in writing everyone's questions that were submitted. And of course, we look forward to seeing you hopefully in person at some point soon. But in the interim, please stay safe, keep your social distance, and continue to do the great work that our industry does. So thank you.